welcome to the Deep Dive. We're here to take, well, a pretty hefty stack of market reports, financial statements, analyst research.
All the good stuff.
Exactly.
Yeah.
And boil it down into the knowledge you really need. Today, our mission is to unpack one of the most, frankly, counterintuitive stories in semiconductors right now. We're looking at Navitas Semiconductor, that's ticker NVTS, and their Q3 2025 earnings.
And this is a really crucial one because just, reading the headline numbers or the press release, it's fundamentally misleading this time around.
Right. Why is that?
Well, when a company is going through such a radical shift like Navitas is, the earnings report isn't just about growth or decline anymore. It becomes almost a test of their strategy. Is it working? Is it validated?
That makes sense. And the core story here, as we see it from the sources, is that Navitas is pulling off this really dramatic strategic pivot. They're intentionally, it seems, dismantling parts of their old business to build something new.
Yeah, it's like a planned demolition almost.
A controlled demolition. That's the phrase used in some reports. So we're looking at a business that's, deep in transition. And weirdly, meeting Wall Street estimates actually meant confirming a huge planned contraction in revenue.
It's completely counterintuitive. How do you pull that off without, crashing the whole thing? That's what we need to understand, the mechanics of it.
Okay, so how are we going to tackle that?
We're using a structured approach, basically a 5-part analysis drawn from several top market reports. This framework helps us get past the official spin,
Right.
and lets us integrate the company's hard data, their cash flow, margins, that sort of thing, with what the market was expecting, and crucially, with what management says they're trying to achieve strategically.
So our goal today is really to give you, the listener, a shortcut to understanding this complex situation. This tension between, okay, this painful pivot might be necessary, but wow, look at the immediate financial disruption that's causing.
It's definitely a messy story right now, but the insights, I think, are pretty fascinating when you dig in.
Okay, let's unpack this then. Where do we start? What's the first data point?
We start where the paradoxes begin.
Let's do it. Now for slide 1, the at-a-glance scorecard.
Okay.
And like you said, if you just looked at the numbers against Wall Street expectations, you might think, pretty boring quarter. Everything was listed as in line.
Exactly. And that alignment, it's ironically what makes the headline so deceptive. Navitas reported total revenue of $10.1 million, which matched the Wall Street consensus estimate perfectly, like down to the decimal point.
Wow.
And same story for earnings per share. The official GAAP diluted loss per share was negative 0.09 cents.
Matched consensus.
Matched consensus, exactly. And even the non-GAAP diluted loss per share, which management prefers, that came in at negative 0.05.
Also matching consensus.
Also matching the non-GAAP consensus. So tick, tick, tick. They hit all the marks.
So on paper, yeah, perfect homework assignment. But in the context of this whole controlled demolition strategy, meeting that $10.1 million target, it basically confirmed to the market, didn't it, that, the demolition is happening and the revenue floor is way lower now.
Precisely. And that confirmation, even though the numbers matched, it set a really negative tone in the market.
Okay.
Markets generally don't like massive disruption, even if a company says it's planned. Our sources show that, despite hitting every single estimate, the stock trended down sharply. It dropped by over 10%, specifically negative 10.25% in trading right after the release on November 3rd, 2025.
Wow. Okay. So that kind of reaction, it's not just about the numbers themselves, right? It's got to be about how the market perceives the risk involved.
Absolutely. Analysts, they acknowledged the strategy might be necessary. They got that Navitas probably had to pivot away from those super competitive low margin areas like mobile and consumer electronics.
Right. The old business.
Yeah. But they immediately flagged 2 big concerns. First, just how severe this near-term decline is. And that was confirmed by the forward guidance, which we'll get to later. It wasn't looking good short-term.
Okay, what was the second concern?
The second was valuation. The stock still trades like a high-growth company, with a premium multiple.
Right.
But when you're in this messy transition with revenue falling, that high valuation makes the risks feel much, much sharper. Any slip-up gets magnified.
So the negative feeling really crystallizes when you look beyond just hitting the estimates for this quarter and instead compare it to, say, last year.
That's exactly it. The year-over-year comparison. That's the real aha moment on this scorecard. We absolutely have to look at the metrics compared to Q3 of 2024 to grasp just the sheer scale of this change.
And the change is staggering, looking at these numbers.
Yeah.
Total revenue, down 53.4% year over year.
53.4%.
It dropped from $21.7 million in Q3 2024 down to just $10.1 million this quarter.
Yeah.
That's more than half their revenue gone in a year.
It's really astonishing when you put it like that. And to add another layer of complexity here, the company's net loss, the bottom line loss, it actually got slightly worse.
Oh.
It went from about negative $18.7 million last year to negative $19.2 million this quarter. So a small increase in the loss, about 2.7%.
Okay, wait. So revenue gets cut in half. The net loss gets a tiny bit bigger. Logically, the loss per share should have gotten much worse, right?
You would absolutely expect that, especially since, loss per share is the total loss divided by the number of shares. If the loss is slightly bigger,
The per share number should be worse, but that's not what
I
happened.
know, and that's the paradox. Despite revenue collapsing by over 50%, despite the net loss widening slightly, the diluted loss per share actually improved.
Improved? How?
The loss per share narrowed. It went from negative $0.10 per share in Q3 last year to negative 0.09 cents per share this quarter.
Okay, hold on. Mechanically, how does management pull that off? How does the loss per share get better when the total revenue just cratered? That doesn't seem to add up on the surface.
It doesn't, right. But this is the definitive proof, really, of that controlled demolition thesis we talked about.
Okay.
The improvement had nothing, absolutely nothing to do with selling more stuff or better margins at this stage. It was driven entirely by just exceptional, aggressive operational discipline, cost cutting.
Ah, okay. So they managed the expense side really tightly.
Incredibly tightly. We need to break down the mechanics here because this is where you see management actually executing the tough part of their plan.
Okay, but before we even get to the expenses,
Yeah.
wasn't there also pressure from the share count itself? Didn't that go up?
You're absolutely right to bring that up, yes. Over that same year, the number of outstanding shares increased quite a bit. It rose from about 184.7 million shares to 212.7 million shares.
So that's dilution. More shares outstanding.
Exactly. And mathematically, dilution is normally bad for EPS, right? You're spreading the same loss, or even a slightly bigger loss in this case, over more shares.
Which should automatically push the loss per share higher, making it worse.
Just precisely. So management had this headwind from dilution they had to overcome on top of the massive revenue drop.
So the cost cuts didn't just have to offset the revenue loss. They had to offset the dilution, too, just to stay even, let alone improve the EPS.
Correct. The operational cuts had to be absolutely massive.
So what does that discipline look like in dollar terms? How much did they cut?
Okay, so let's look at the numbers. The year-over-year revenue loss was $11.6 million. That's the $21.7 million from last year minus the $10.1 million this year.
Right, $11.6 million hole.
Management basically looked at that hole and said, okay, we need to cut more than that from our operating costs, and they did.
How much more?
Total operating expenses were slashed by $14.3 million.
Wow.
They dropped from $37.6 million in Q3 2024 down to just $23.2 million in Q3 2025.
So let me get this straight. The revenue dropped by $11.6 million, but they cut costs by $14.3 million.
Yes.
So the cost management, the $14.3 million cut, was significantly greater than the revenue loss. They were more successful, you could say, on the expense side than the speed at which the old revenue vanished.
That's exactly the right way to think about it. That superior cost control. It did more than just offset the revenue decline. It led to a really substantial narrowing of the loss from operations.
Okay.
That operating loss improved from negative $29.0 million last year to negative $19.4 million this quarter.
That's a $9.6 million improvement in operations.
Right. And that $9.6 million operational improvement was strong enough to completely overwhelm both the $11.6 million revenue drop and the dilutive effect of all those new shares.
Resulting in the slightly better loss per share, the minus 9 cents instead of minus 10 cents.
Exactly. It tells you the strategy isn't just talk. The internal restructuring, the really hard part needed for this Navitas 2.0, it is being executed successfully, at least on the cost side.
This is really critical, I think, for you, the listener, to grasp. When you just see a headline saying a company met estimates, you absolutely have to dig deeper. In this case, meeting estimates actually confirmed a massive strategic shift. And it was only possible because of this extraordinary internal cost cutting. It wasn't about sales growth at all. It was a success of discipline.
Discipline and execution on the hard choices.
Okay. That makes sense of the first paradox.
Yeah.
Now moving to slide 2. The engine of profitability.
Right.
If slide 1 showed us a paradox in the per-share results, This section seems to reveal, well, almost a split personality within the business itself. Because now we have to talk about the huge difference between GAAP and non-GAAP profitability.
Yes. This is the second major filter we need to apply to really understand Navitas' financial reality during this pivot.
So maybe just quickly remind us, GAAP versus non-GAAP.
Sure. So GAAP, generally accepted accounting principles, that's the official rule book. The standardized numbers used for, legal reporting, SEC filings.
Got it.
Non-GAAP, on the other hand, these are alternative numbers that management presents. They usually exclude items they consider non-core or not representative of ongoing operations, things like stock-based compensation, maybe restructuring charges, or, importantly here, non-cash amortization expenses.
So management is essentially saying, look at this non-GAAP number to see how our core products are really performing operationally.
That's the argument they're making, yeah.
And the difference in the gross margin figures this quarter. Wow, it's dramatic. Almost alarming if you just look at the official number.
Yeah.
The GAAP gross margin was reported as negative 2.0%.
Oh, feel good if it's 2%.
That sounds like a complete disaster, especially compared to the positive 21.5% GAAP margin they had in Q3 last year. A negative gross margin literally means, by the official rules, they lost money on every single product they sold before even counting R&D or sales costs.
It looks terrible on the surface, absolutely.
Yeah.
But then you look at the non-GAAP gross margin, and that number shows the, let's call it the true operational health of the products they actually want to be selling long term. The non-GAAP gross margin was a very stable 38.7%.
38.7. Wow. So GAAP is -2, non-GAAP is plus almost 39. That's a massive difference.
It's huge. And that non-GAAP number, 38.7%, it's only a slight dip from the 40.1% they had in the prior year's quarter. So very stable operationally.
Okay, that's a 40 percentage point swing between the official GAAP loss on goods sold and the non-GAAP operational profit. We absolutely have to deconstruct that. What bridges that enormous gap?
Yeah, for the listener trying to figure out, okay, which number is real, we need to pinpoint what's causing that GAAP number to look so, well, ugly.
What is it?
The reconciliation tables in their filings, they clearly point to one major item, a substantial $4.0 million non-cash charge.
$4 million non-cash.
Okay.
What's the charge for?
It's for the amortization of intangible assets. And crucially, under GAAP rules, this charge gets included in the calculation of the cost of revenues or cost of goods sold, COGS.
Okay, let's slow down on that $4.0 million charge, because this is where, the accounting meets the company's history, right? Amortization means spreading out the cost of an asset over time.
Correct.
And intangible assets, in this context, that's usually things like intellectual property, patents, maybe brand value or goodwill from companies Navitas acquired in the past.
Exactly right. Imagine Navitas bought a smaller chip company a few years back, maybe mostly for its patents and its expert design team.
Okay.
When they made that acquisition, they had to put a value on that intellectual property on their balance sheet. That's the intangible asset. Now, accounting rules, specifically GAAP, require them to gradually expense that purchase price over the asset's estimated useful life.
So this $4.2 million isn't money actually going out the door this quarter?
Not a dime. No cash physically left their bank account because of this charge. It's purely a bookkeeping entry.
An accounting artifact, almost. A hangover from past M&A deals that artificially inflates the cost of making their products today, at least according to GAAP.
That is the absolute core implication here. While the GAAP results are legally correct and follow the rules, they're heavily skewed, heavily distorted by this historical non-cash accounting decision.
Right.
The moment you strip that $4.0 million amortization charge out, which is precisely what the non-GAAP calculation does, you're left with that clean, stable, operationally irrelevant gross margin of 38.7%.
And that stable 38.7% non-GAAP margin, that's the concrete evidence, isn't it? The operational proof that the products at the heart of this new Navitas 2.0 strategy are fundamentally healthy and profitable on their own.
Yes. These are the higher power gallium nitride, GaN, and silicon carbide components they're targeting for those premium markets like AI data centers, renewable energy infrastructure, industrial power.
Markets where performance and efficiency really matter and where they can presumably charge more.
Exactly. The gross profitability of those new strategic products looks excellent based on that non-GAAP margin, and that really helps validate the risk they're taking with this whole pivot. It suggests the target business is potentially much better.
So the margins are telling a story of two companies coexisting for now. There's the legacy company dragged down by historical accounting quirks and the low-margin consumer stuff.
Which gives us that ugly negative gap margin.
And then there's the future company, the Navitas 2.0, selling these highly profitable, technically advanced products.
Which gives us the healthy 38.7% non-GAAP margin.
And the fact that the non-GAAP margin stayed pretty stable, even while the overall revenue mix was shifting so drastically away from the old stuff, that seems like a really strong sign.
It's probably the strongest technical point financially in favor of management's current strategy. It suggests the core profitability engine for the future is sound.
Okay, that clears up the margin picture significantly. Now let's look at slide 4, financial strength and shareholder rewards.
Right.
We've established, okay, this company's doing a deliberate, multi-year transformation, a controlled demolition, followed by, hopefully, reconstruction.
Yeah, that's the plan.
But that kind of risky long-term project, it absolutely demands serious financial strength, right? You need a strong foundation to survive what could be several quarters of lower revenue and to fund all the R&D for the new stuff.
Oh, absolutely. The balance sheet has to be basically bulletproofed. Otherwise, any external shock, maybe a sudden recession or interest rate spiking even higher could completely derail the pivot. Financial stability isn't optional here. It's the prerequisite for being strategically bold.
And based on the Q3 report and the analysis we've seen, Navitas seems to have that essential foundation. How much cash are they sitting on?
As of September 30th, 2025, the company reported cash and cash equivalents of $150.6 million.
$150 million. That sounds like a pretty substantial war chest.
It is, and that cash reserve is absolutely critical right now. It acts as a non-negotiable buffer, meaning they can absorb this near-term revenue hit that was confirmed by their week forward guidance. They can keep funding their ambitious R&D programs because Gijan and Surly technology isn't cheap to develop.
Right.
And they can invest heavily in sales and marketing, what they call go-to-market initiatives, to actually win those new high-power design contracts. And they can do all of that, hopefully, without having to run out and raise more money through selling stock right now, which would be expensive and dilutive.
Okay, so a good cash cushion. How about the other side of the balance sheet, debt? How leveraged are they? We usually look at the debt-to-equity ratio for that, right?
Exactly. The debt-to-equity ratio is the key metric. It compares their total liabilities, what they owe, to their total stockholders' equity, the book value of the owner's stake. It basically tells us how much the company relies on borrowing versus equity funding.
Okay, so what were the numbers?
For Q3, total liabilities were reported at $59.2 million.
$59.2 million,
Yeah.
Okay, and equity?
Total stockholders' equity was $371.0 million.
Okay, so if we do the math,
Okay.
$59.2 million divided by $371.0 million, that comes out to 0.16.
0.16.
How should we interpret that? Is 0.16 high or low?
That is an exceptionally low ratio, especially for a tech company, even one in transition.
So what does that low number tell us?
It clearly indicates that Navitas is financed almost entirely by equity, not by debt. Think about the strategic advantage that gives them, particularly right now, in this kind of high interest rate environment where borrowing is really expensive.
Right, they're not sweating big interest payments.
Exactly. They're largely insulated from changes in interest rates, and maybe just as importantly, they're not beholden to restrictive debt covenants. The kinds of rules banks might impose that could limit how they spend their cash or force them to hit certain profit targets before the strategy has time to play out.
So that low leverage, combined with a strong cash position, it really gives management maximum financial flexibility to actually execute this risky Navitas 2.0 plan. They can afford to prioritize getting the long-term strategy right over hitting short-term profit numbers or worrying about debt payments.
It's the financial safety net supporting the whole transformation, yes.
Okay, so if they have this cash and low debt, how are they choosing to allocate that capital? Did they return any to shareholders in Q3, like dividends or buybacks?
That stability really dictates their capital allocation strategy right now. And the report confirmed, no. During Q3, Navitas did not return capital to shareholders. There were no dividend payments, and they didn't execute any share repurchase programs.
Now, for some companies, especially older, more mature, profitable ones, maybe that would be seen as a negative. Like, why aren't you rewarding shareholders?
Right. Investors often expect that from established players.
But for a company like Navitas, which is still technically growth stage, currently unprofitable, and right in the middle of this incredibly capital-intensive, almost existential pivot, not paying out capital seems like the right move.
It's absolutely the appropriate strategy from a fiduciary perspective. Their primary duty right now isn't really about making shareholders happy with, small symbolic payouts today.
What is it then?
It's about maximizing the long-term value of the company. And the best way to do that right now is to reinvest every available dollar back into the core business.
So funneling that $150 million cash pile into R&D.
Yes. Maintaining their technological edge, especially in these complex GaN and CQ materials, where the science is still evolving rapidly.
And into sales and marketing.
Absolutely. Into securing those crucial foundational design wins in the new high-power sectors they're targeting. Those wins are the future revenue stream. So the fact that they're not doing dividends or buybacks signals a laser focus on rebuilding a much more valuable, much more profitable enterprise down the road. Capital is being directed wisely, it seems, toward future growth.
Okay, that makes sense. We've covered the operational side, the cost cuts driving the EPS surprise. We've covered the financial foundation, strong cash, low debt. So finally, we turn our attention to slide 5, the road ahead management's outlook and key takeaways.
Right. This is where management gets to tell their story about the future. And crucially, where we find out just how long this revenue pain is expected to continue.
And predictably, management's discussion, according to the sources, was really focused on framing those Q3 results as, strategic and deliberate, not accidental or a sign of failure.
Yes. The CEO, Chris Alexandre, was quoted directly confirming that the company is executing a strategic pivot from consumer and mobile markets to these fast-growing, more profitable, more sustainable, higher-power segments. They owned the narrative.
But just saying you're pivoting isn't enough, right? The market, analysts, investors, they need proof points. You need evidence that this pivot is actually starting to work, that you're gaining traction in those new, better markets. You can't just jettison half your business without showing some success in the other half.
Absolutely critical. You need validation. And Navitas did deliver a major point of validation in their discussion by highlighting their deep collaboration with NVIDIA.
NVIDIA. Okay, that's obviously a huge name, especially in AI. What was the specific connection?
The NVIDIA partnership is really the cornerstone of this whole reconstruction narrative they're building. Navitas was specifically recognized by NVIDIA as a power semiconductor partner for something called its next-generation 800V DC architecture in AI factory computing.
Okay, AI factor computing, 800V DC architecture. Let's break that down. Why is that specific application such a big deal, and why is it important for Navitas' technology?
It's arguably the perfect storm, the perfect application for the kind of advanced wide bandgap semiconductors that Navitas makes, the GaN and SiC chips.
Why?
Well, think about these massive AI data centers, the AI factories that are training and running large language models and other advanced AI. They consume enormous amounts of power, and they need that power delivered incredibly efficiently.
Right. Efficiency is key to managing cost and heat.
Exactly. Now, the move to an 800-volt DC power architecture, up from older 48-volt systems, allows for thinner cables and less power loss over distance within the data center. But operating at 800 volts puts extreme stress on the power conversion components.
And traditional silicon chips struggle there.
Traditional silicon power components, they tend to lose a lot more energy as heat when they're switching power at the high frequencies and high voltages needed for an efficient 800-volt system. They become a bottleneck.
Ah, so this is where GaN and SiC come in.
Precisely. Gallium nitride, GN, and silicon carbide, CEC, are inherently much better suited for these high voltage, high frequency, high temperature conditions. They switch faster, lose less energy as heat.
Which means you can build power supplies that are smaller, lighter, and critically much more energy efficient.
Yes. So for Navitas to secure a spot as a partner in NVIDIA's next-gen 800V architecture, it's huge validation. It says their technology isn't just, interesting R&D. It's viewed as necessary and competitive for the absolute cutting edge of the most demanding computing segment on the planet right now, AI infrastructure.
Okay. So the NVIDIA win serves as crucial proof that the technology works, that it's relevant, and that the strategic pivot toward these high-power, high-margin customers is potentially viable. This is the key counter-argument they can make against those terrible Q3 revenue numbers.
It represents the potential for future high-quality revenue. It's the reconstruction part of the story starting to take shape. But, and this is a big but, the forward guidance they gave for the next quarter, for Q4, reflected the painful continuation of the demolition phase. And that's what really seemed to drive the negative stock reaction in the short term.
So the pain isn't over yet? the revenue decline continues.
Apparently so. For Q4 2025, net revenues are expected to be only $7.0 million, plus or minus a quarter million.
7 million. Wow, that's down even from the $10.1 million in Q3.
It is. It confirms a further sequential decline, as well as another massive year-over-year drop. It suggests the revenue floor from shedding the old business is even lower than Q3 indicated, before any significant rebound from the new stuff kicks in.
Did management try to explain why Q4 would be even weaker?
Yes, they were very direct about it, linking it explicitly back to the strategy. They stated the weak Q4 forecast was, and I'm quoting the essence here, due to the company's strategic decision to deprioritize low-power, lower-profit China mobile and consumer business.
So they're basically saying, look, this is the unavoidable cost of clearing the decks. We're actively cutting off the oxygen supply to the old, unprofitable parts of the business, and naturally, that shrinks the overall top line for the next few quarters. Bear with us.
That's the message. It's the short-term pain required for the hoped-for long-term gain.
Okay, so if we try to synthesize this whole story based on our structured analysis across these slides, what are the key takeaways for you, the listener?
I think there are four main points that really emerge.
Okay.
First, that huge 53.4% revenue drop in Q3. It wasn't a business failure in the traditional sense. It was largely a success in executing the first, very painful stage of their strategic pivot. It was essentially revenue decline by design.
Okay. Takeaway 2.
Second, the operational execution on the cost side was exceptional. Management showed really strong control by slashing expenses, $14.3 million cut, even more aggressively than the revenue fell, $11.6 million drop.
Right, which allowed them to narrow the operating loss and actually improve the diluted EPS against the odds.
Exactly. It proves they can execute the difficult internal restructuring needed for this Navitas 2.0 plan. They can manage the controllable parts well.
Got it. Third takeaway.
Third, despite that strategic validation from NVIDIA and the successful cost-cutting, the market reaction was driven by skepticism. Specifically, the weak Q4 forecast projecting only $7.0 million in revenue next quarter.
That spooked investors.
It did. Investors focused on the severity of the short-term disruption and the inherent risks involved in navigating this kind of multi-quarter transition. The uncertainty is high.
The final takeaway.
And finally, looking forward, the entire investment case for Navitas now hinges completely on converting those early high-power design opportunities, especially that flagship NVIDIA collaboration, into significant, sustained, and importantly, scalable revenue streams.
The future is entirely tied to how quickly and successfully they can ramp up sales in these new high-power markets.
100%. The pivot has to deliver on the top line, and soon.
Okay, so the final narrative that really emerges from this whole deep dive seems pretty clear now. Navitas' Q3 results, while looking ugly on the surface, actually represent a necessary, painful, but arguably well-executed first step in their big strategic transformation.
Yeah, that controlled demolition for future reconstruction theme really holds up. They successfully cleared the ground, shedding that legacy low-margin consumer revenue.
And now they're actively trying to rebuild around these validated high-growth pillars. AI data centers with partners like NVIDIA, renewable energy infrastructure, industrial power applications.
All areas where their GaN and SiC tech offers real advantages.
And hopefully, for you listening, the power of using this kind of structured framework becomes apparent. It lets you move beyond just the shocking headlines like a 53% revenue collapse.
Right.
And apply a repeatable method to actually understand what's going on under the hood at any company, especially when navigating massive strategic change. You can start to differentiate between, say, genuinely poor performance and a deliberate planned strategic contraction like this one.
It helps you ask the right questions.
Exactly. Which brings us to the final question. The focus now shifts entirely to the pace of that reconstruction phase, doesn't it? That NVIDIA partnership is an incredible first step, no doubt. Huge technological validation.
Absolutely.
But it leaves us with a final, maybe provocative thought for your own research. Gaining that crucial design win is great, but the market is clearly skeptical about the timeline. So the question is, what level of actual revenue scale does Navitas need to achieve from these new high-power sectors? And, perhaps more importantly, how quickly must they realize those design wins and convert them into dollars before the market's current focus on weak near-term guidance hardens into a long-term structural valuation problem for the stock?
Yeah, the clock is definitely ticking for them to show tangible results on the top line from Navitas 2.0. How much patience will the market have?
Something to watch closely. Food for thought indeed. Thank you for joining us on this deep dive.
My pleasure.
This report is for informational purposes only and does not constitute financial, investment, legal, or tax advice. Do your own research. This content was generated by an artificial intelligence model.
Like and subscribe to StockAnalytics.ai. YouTube channel. Members get access to our library of S&P 500 stocks and NASDAQ 100 library we are building out, and also get priority requests for company deep dives.